Our panel is void then. So we're going to be talking about the trends shaping the evolution of VC, of course. Most of the time we're going to talk unicorns and how do they fare. So for that, I have to invite my guests today. Let me call on stage Nrutya Madhapa, partner and head of growth and capital development, 314 Capital. Nrutya, please come on stage. Round of applause. You guys got to keep it going, guys. Keep clapping, please. I've got Abhay Maheshwari, Chief Financial Officer, Jupiter Capital, India. And where's Sudhir? Sudhir, are you here? You guys can clap louder. Thank you. Come on, Abhay. Come on. I've got Miki Ide Katsumata, President and Chief Operating Officer, member of the board, Innovation Network Corporation of Japan. Come in, Miki Ide-san. Miki. I've got Madhu Gupta Khandelwal, who's the managing partner of EthAum Venture Partners, Singapore. Come on, guys. You can clap for us. We are going to have a very difficult session. It's going to get through only with you. And by the way, ladies and gentlemen, one of them is missing. Where is Sudhir? Is Sudhir here? Or has he dropped out? Okay, Sudhir's dropped out and I'll probably talk to him later. So let's get going. So Claude wants to say something.
Just to explain, Sudhir had an emergency family issue and he had to leave already this morning in a kind of hurry because there have been some serious issues, health issues in the family. So this is why he's not here. Otherwise, he would be there.
Thank you, and we wish that everything's safe back home. I'll talk to him later, Claude. Thank you for letting us know. So how many of you are startups here? Show of hands, please. That's about, very nice, quite a number of startups. How many of you have raised money? Show of hands, please. 1, 2, 3, 4, 5. 5 of them. How many of you think that 2023 was a bad year? Show of hands. Only one. We'll talk to you later. You should ask questions. So okay. So everybody thinks that 2023 was a terrible year in terms of startup valuations. But I'll tell you one thing. After being in journalism for 25 years, I think it's just a blip here for Indian startups. It's only grown. It's getting bigger. You know, the registration numbers have gone through the roof. I keep talking to government officials. They say it'll go over 100K startups, and I think it's going to be one of the largest startup ecosystems. And people are hungry for money, and these are the people who will enable it. We're going to start like this. We're going to have them do a quick round of introductions about themselves and what they do in their organizations, perhaps 30 seconds. And then on, we'll go into some deep questions. So I want to talk to you, Madhu. What do you do at EthAum Venture Partners? And you're from Singapore, correct?
Yes. So we are revenue scaler for B2B tech-enabled startups. We are based out of Singapore. So far, we have worked with 100+ startups. All are global B2B, deep tech, or tech-enabled startups. So we help these startups in growing their revenue, helping them in acquiring more enterprises customers depending on their ICPs, and also fund these startups.
Okay. Miki, a little bit about yourself, please.
Sure. Our company, INHJ, is formerly known as Innovation Network Corporation of Japan, and we are an investment firm in the form of public-private partnership between the Japanese government and big traditional companies. Our mission is twofold. One is through an open innovation and making private equity investment, we are expect to strengthen the Japanese industrial competitiveness, number one. Number two, by making an investment in the startups to nurture and grow and have the new industries for next generation to come. Thank you.
Nrutya and I have known each other for a long time, and we've grown with the startup ecosystem in India. You should tell them what you do at 314 Capital, and a little bit about how the startup ecosystem's grown, really, with us. Guys, can you fix that, please?
Can you hear me now? Yeah. Okay. Hi, everyone. Thank you so much for having me here. I'm Nritya. I'm a partner at 314 Capital, one of India's leading early-stage venture firms. We manage over $500 million deployed across early-stage companies, across sectors from consumer, software, fintech, and a very focused strategy around health and sustainability. We've been around for about 7 years now, and through that journey of seeing that entire startup ecosystem evolve in the same period, we've It's been an exhilarating ride. We've seen companies that were built here, sold exclusively globally, to finally building really fantastic product for the Indian landscape. Indian software was typically called the value option, or like the pricing option, lower priced option, but now they're winning on product heft, alone beating out the biggest global names in this space. We've seen very interesting deep tech emerge out of here, even to the continued skepticism of the global venture space, I might add, but really seeing incredibly encouraging innovation for India's specific problems. So no longer are we just taking templates from around the world and adjusting them for the Indian context. There are grounds up based on consumption patterns, based on software consumption behavior, etc., products being built for India and Indian audiences. So we've seen that emerge across the board, but the startup ecosystem with the VC ecosystem has also evolved. I'm sure we're going to talk a lot more about that. But thank you again for having me here today.
Abhay?
Yeah. Hi, good afternoon all. I represent here Jupiter Capital. Jupiter Capital is a private equity firm to start with. So we are in this space from last 18 years. And now we are entering into venture space as well. So we have launched our first fund. In a PE space in the journey till date, the investments are diversified across sectors. So we are into IT, we are into defense, then we are into media as well as retreats, medical devices, and even the EV. We are the one who's invested very early stage into the commercial EV. So now with this new fund, we are mostly focusing on the tech side. It's a fund which is focusing to invest up to pre-Series A, and some of them will go up to Series A as well, and mostly focused on the tech side, what we are currently looking for. So various different verticals within tech, which we are focusing right now.
Okay, that sets the context for everything. For me as an entrepreneur, I have 2-3 burning questions, okay? I mean, I thought building a startup was always to build great teams, and you have you have some kind of direction to profitability. But nowadays, the press says that there's only sustained growth and focus on profitability at this point of time. I want to throw this question to you. I mean, did startups focus more on the growth and less on profitability? What is going on at this point of time to set the context for 2024? Is there more resilience in terms of showing capital efficiency and creating value rather than valuation? Nutya, I want to start with you, please.
No, thank you for that. I think materially, fundamentally, nothing has changed. What makes a good company is still the very core business itself, and for a business to work, you need to have the right unit economics and be revenue generating. In the low interest rate environment, there was a lot of money that was available, and the right entrepreneurs made rightfully the good use of it to sort of shore up their balance sheets in 2021. Probably an unprecedented year we probably won't see for a couple more decades while the world grapples with its own problems globally. But what's interesting over the last few years has been a return to the mean, which is essentially a renewed focus again on business fundamentals, really rethinking how you can build deeply efficient and optimized businesses in India. Indian businesses forever have been some of the most efficiently built businesses in the world. And we're seeing a revert to that mean. And it isn't, I mean, I don't think what VCs think is valuable in a company should ever define how you build a company. But it is true that with interest rates going up, a little bit less capital inflow, there's a lot more cautious investment happening today, which is necessary, which honestly 2021 continues to be an aberration, and we should view it as that.
Okay. Mickey Desan, you should tell us that you said that although 2023 seemed bad, but in Japan, the story for deep tech is different. In fact, one of your startups just had a revenue multiple of 10x, I mean, when it was listed, right?
Sure.
So you want to talk about the context of how there is renewed interest in profitability, but there is also an interest in companies that are building value over the long run.
Okay, sure. The collapse, the myth of revenue multiple as a valuation tool did collapse also in Japan, that's for sure, in 23. But again, at the same time, that may sound a bad thing for startups. But again, as the founders of startup fully understand the situation and say, okay, if what investors are looking at a better bottom line, yes, we can accommodate their expectations simply by cutting marketing costs, R&D costs, and they can instantly create a book profit. But again, in the long-term business, I'm not sure whether this is really a right move for a long-term growth perspective for startups. But again, on a daily basis, the startups quoting revenue multiple is the one who is still burning cash. So they have to do a fundraising for survival. So for the sake of the second best short-term solution to focus on profit, founders, they do realize the need for the change in strategy. But again, expectations shift toward a decent revenue multiple. They are expecting to come back.
No, you should tell them about that startup, that space tech company you're telling me about. People pay a premium for that company. And there is a reason, because they're solving real value. Why don't you give that example to us?
Sure. Out of a total 104 investment in a portfolio, we made 4 investment in the startup sectors. We are lucky enough to have already 2 companies listed, one in Tokyo, another one in Nasdaq. And yesterday, we have another company listed at the Tokyo Stock Exchange. And we reached, thank you, we reached the landmark US $1 billion, which is, for us, is a pleasant surprise. The name of the company is Astro Scale Holding, and their service is to remove space debris. And reportedly, there are more than 20,000 space debris rotating around the globe, very fast, very dangerous. And there is a growing demand for newly launched satellite. For the client who needs to have a new satellite on orbit, if they find that debris, they have to get rid of it. So the Astro Scale Holding, in response to the demand, they put together one sort of a killing machine, laser weapon, and put it on the rocket, launch to the space, release to the space, and the killing machine identify and find a space debris, getting closer until they grab, like bare hand, the debris. By the way, they are not sitting there, they're moving so fast, okay? Then they try to deorbit the debris toward the Earth, and taking advantage of gravity, the more they rotate, they get closer to the Earth, up until they dive toward the ocean.
And they burn in orbit.
To burn themselves down to pieces and ashes. That's how they get rid of the debris. And 9 years ago, when I first heard about this story, I thought it was just a joke, or just a story in a scientific novel. But apparently, 9 years ago, the company was a very early stage, not much employees, no revenue, no projection for the next several years. But as of today, the company hired 500 engineers, office in Tokyo and Denver, Colorado, and literally, they hired hundreds of rocket scientists. So the nature of this Astro Scale Holding is to have 2 natures. One is global. The other one is deep tech. So that, reaching $1 billion may give an implication that the market may have to start accommodate a decent revenue multiple rather than adequate or very little market revenue multiple.
Fantastic. You would agree with that, Abhay? You would agree with that, right, Madhu? I mean, these are the kind of startups that you look for as investors. So across stages of investing, both of you were telling me earlier over coffee that, the seed stage and the Series A stage is still exciting. In what industries, agnostic of industries, or what are the type of entrepreneurs that you're looking for? Mature entrepreneurs, younger entrepreneurs? When I say mature, 40 plus, right? Yeah.
So, yeah, see, from the sector side, we are looking again on the tech per se, but yeah, when it comes on that, what is evaluating or what is changing in these years where, the way of investing is changed. Now it is, one, definitely the pedigree of the founders and the stability and the growth, sustainability of the business idea, which was there earlier also, but now the focus has a lot shifted on that how confident is the founder or the founding team into their idea, how committed they are to it for ups and downs into it, and how is the business idea. Uh, Sustainability and growth is something which is coming up as a very strong thing. Earlier it was uh, what I say is a change. Things are same, but priorities has got changed. Expectations are same. So even earlier it was expectation of growth. Today also, but now it's a sustainable growth. Earlier it was an aggressive growth, now it's a sustainable growth. Earlier or few years back, like 3 years, 2 years down the line, we are okay to do, growth at any cost. But from there it has shift to cost control and now even to cost optimization. So those are the things coming up, as a change of theme when any investor is now looking to invest, and the way it has been guided and look for that how the thing should be.
You talked about growth optimization. Madhu, I want to come to you. You said you fund a lot of B2B companies yourself. Nitya, you funded B2C too and B2B. So I want to get to the B2C later. On the B2B side, you said, there is money available to startups who will sell globally, right? So when you talk to your LPs, what do they look from these startups? They want them to go to Americas, they want them to sell in Southeast Asia. Is there enough dry powder when you talk to these LPs to come and reinvest in your second and third funds?
No, in terms, LPs don't look much where these, their main interest is how profitable these startups are whenever they are investing. Recently,
on the B2B side.
Huh?
On the B2B side, right?
On the B2B side, of course, yeah. And of course, for deep tech, the gestation period is more, so the ROI will be will take more time. When it comes to the serving area of these startups, for B2B startups, it's difficult to sell their solution in India compared to the other geography. Since we work with a lot of B2B startups and we help them with the market access, we have realized this thing. So scheduling calls with the corporates in India is not difficult, but getting the deal signed is on a different level. And getting the money out of those corporates is another challenge. You can
so
do
you're
the
saying
pilots.
Selling within India is very difficult at this point of time?
Yeah. But when you are trying to sell to other geographies, let's say US, where they are very, very much willing to listen innovations and adopt those innovations, it's easier to sell these B2B solutions. So we do see lots of founders, Indian founders, as soon as they have product market fit in India, they are eager to go out of the India and sell other customers in different geographies.
Would you agree with this thesis? In a sense, selling in India is difficult because you guys have done a lot of B2B deals too.
Yes.
Is it? And I want to throw this open to you also, Abhay. Is it easier? Or I see a lot of GCCs coming into this this conference, and they say that they want to work with B2B companies. But like she said, it's harder. But why is it hard? And from your experience?
Yeah, I think it's a couple of things. It's obviously gotten a lot better over the last 7 to 8 years. We, for instance, one of our first investments was a company called Darwinbox. At that point, it wasn't that we were a very small fund. We were like 15 million new kids on the block. Every major VC in the country had seen them, and similar to common belief that, why would you try to sell into India? They were clear that there was a space for a horizontal software in HRMS to unseat the SAPs and Workdays of the world, which were just not serving the Indian sort of audience. What we've seen from some of our LPs, our institutional LPs, was an increased propensity to digitalize and frustration increasingly with global solutions that weren't purpose-built for India, right? You would spend $2-3 million after you paid for SAP in order to make SAP work for you, right? That is essentially how global software approaches India. You have an army of people, companies around just enabling you to utilize that software. And these are fantastic founders, unbelievable pedigree, but that insight that suddenly that digitalization intent was changing on the business side allowed us to sort of make that investment. As you know, now they're north of 60 million in revenues, exclusively selling into India and SEA and scaling out. And they're also unbelievable at execution, but there is a propensity to buy. It is a longer gestation period. The ACVs may be not what you're able to capture there, but here too they've signed $1 million contracts, annual contracts from the largest banks in the country, etc. But it took them 6-7 years to get here. So
would they be an outlier of sorts in this
Sorry?
case? Would Darwin Box be an outlier in this case?
It isn't, because we've repeated this across multiple spaces. We've invested in FinInfra, which is essentially software for banks. And as you can imagine, it's the hardest customer in probably India to sell into. Extremely long gestation cycles, wedded to software they put in 30 years ago, maybe moving because of some regulatory shifts now. Really fantastic growth there. It's about knowing how to work the system. It is an unusual customer. There's a higher demand on customizations, etc., and holding your ground. The thing is, finally, we're seeing large corporations also come meet in the middle. Like I mentioned earlier when we introduced, we've gone from Indian products being a better value to actually being better products. So when you think about it and you hold them side by side, you realize that Indian products are winning against some of the global counterparts. We invest in companies building in India for the world as well from day one. So it's not that, but what we've realized with companies selling into India is you need to have a SaaS layer, pure software sales, and a little bit that's also a little services or an infrastructure play. Are you selling into a distribution player and you're building software for that? You can't be a pure software play.
Again, these are mature entrepreneurs, right? These are
very
not
mature. So that's the other bet, right? Like it's usually industry experts, folks who have navigated this industry before, probably come from the same industry, etc., who build for these sectors.
Abhay, would you agree with that statement that it's important to fund people, especially on the B2B side, look at people who can build value for large organizations and scale it? And that makes a lot of sense, like she just said.
Yeah, I agree to that for to the extent that this is something which is the requirement. But I just want to add few data points here, that while yes, these are the things that sometimes you have to shift your base or your corporate offices to raise your revenues and get a better fundraise and all. But this is also changing with time. Even if we see last year 23, so while the overall deployment has reduced, but in that if you see the mix has changed. This time the domestic investor has put more money into Indian companies. So what I'm trying to say that domestic base itself is increasing, things are happening. So from that point of view, I think this thing will change as the time and fast it is changing, that you stay in India, work in India, economy is growing, and there are good investors still in India only who can, invest into you. So those all things may continue to diversify the business, look for the better growth, but not per se that if I'll not shift the base, there's a concern in terms of, top line raise or fundraise and all those things. So that's
so what is still hot is Series A is going to be hot. You guys are getting good deal flow, I'm sure. All of you, I want to ask you, are you getting good deal flow on the Series A side or more from the Series B, Series C side, follow-on rounds? Madhu?
Yeah, so I mean, if you talk about 2023, then after this 2021 and 2020, most of the VCs have shifted their focus to seed deals, because given their round sizes are smaller, the risk associated is also smaller, and their valuations hasn't been that fluctuating compared to the Series A and beyond. So the focus definitely has been the seed stage startups. If I talk about Singapore in 2023, if I compare both the deals, seed and Series A and beyond, there have been 450 plus deals at seed level and only 29 Series A and beyond. So there is a huge gap, and that wasn't the case earlier. So because of 2021 and 2022, the fluctuation that came, or the rise.
I would have thought on the B2B side, COVID would have only accelerated digitization, right? Or was it a hype cycle? Because you had such few deals in Singapore, only 29 in Series A. Why so? I'm asking why.
For me also, it was seed. Yeah.
You want to say something, Nitya? And you, Mickey, you can also say something. Just go for it.
Yeah, so tying a couple of those points, right? Like he said, the domestic investor base has gotten deeper. A lot of foreign capital started being a little bit more conservative. So the crossover funds essentially disappeared. We had some Asian funds who were looking at India. There was a lot of European capital that started looking at India very carefully. But just as the VC ecosystem itself, there's a major gap within that Series B pool. We don't have enough mid-market domestic funds that are able to sort of also, as a mandate, invest there, right? We have them now. A lot of new ones are coming up. We've got, of course, A91 who's done this really well up until now. Westbridge also storied past, but a lot more new ones like Tenacity, Elevate Partners, Avatar Growth Partners, who are all now stepping into their first and second fund. So I'm really seeing the VC ecosystem also evolve to fill the gaps in capital that sort of existed, broadly. So that's one of the reasons that maybe the Series B's dipped. If you ask me, actually, it was the best time, 22, 23, for the larger growth players to enter tech, because valuations were suddenly more reasonable. They had the pick. There were the few people who did not invest as much in 2021, had enough dry powder to take their pick of the very best companies and take their time in evaluating it as well. It was very frustrating as an early stage fund manager to see how long those evaluation cycles became. But even then, there were fantastic deals done over the last few years that were very tempered and very well set in terms of value, and allows for sort of, investors also to make money, and for companies also to be able to grow well.
Great context. Making from the Japanese perspective, what type of rounds? Is it Series A again, Series B, C? Again, we're talking about B2B at this point of time. What's the flavor there?
Well, it also depends on the size of the venture capital. Most of the venture capital says, okay, we are going to start with a seed, early, middle, later. We cover all the stages, but they don't. When the size of the venture capital is limited, if the management fee per year is 2 or 2.5%, they have to put 20% aside from the size of the fund. For the rest of the net cash used for investment, let's say in the case of $50 million investment, all the cash they can use for investment is only $40 million. If they want to fully diversify the portfolio, they have to make 30 to 40 investment to start with, which means they have no room for follow investment. But some other sophisticated investors tend to focus on selected number of portfolio at the risk of or at the sacrifice of benefit of portfolio diversification, so that they can put certain portion of the fund aside for their own portfolio company is follow investment. So it depends on the size of the company, depends on the investment policy and the sophistication of the capitalist. There are many situations in Japan.
Okay. Got it. Now I want to get into this, before I open it up for the audience for questions, I want to get into this thing called the unicorns, right? And we in India, celebrate this like no other. We pep up the media peps up all these startups and then brings them down so fast. So between controlling the narrative and at least the B2C side, and I've seen a lot of brands crop up and they've done very well, like Nike has done very well. Obviously, Zomato also is trying to make a comeback. Everyone's doing something. But is it unfair to say that, okay, just because there were only 2 or 3 unicorns added over the last couple of years, that the story of unicorns is over? I think India is only going to double it, right? Abhay, you have to tell us, it's still a great opportunity. Just 10 years ago, there were 10,000 brands, and not even 10,000, 5,000 brands. Now there are 100K brands. Consumption's over the roof, right? That's here to stay. But just talking unicorns, what has changed? Has the narrative changed suddenly that you have to be capital efficient and don't go sell to consumers anymore, don't advertise as much? What is happening? This is what's confusing me. That's where I want to draw a difference between B2B and B2C, because B2B, you've got to win great customers. B2C, you have to advertise to have consumer mindset. So what's happening there in your portfolios?
Your question is on the number of unicorns coming up now.
Yeah, and do they have to be, what are they being efficient at? What are they being efficient at? Are they efficient at the marketing process? Are they doing finance controls by not hiring a lot more people or by laying off people? What is happening in your portfolio?
See, now it's a mix of all. You have to focus in most of these metrics. So what they have, first I'll come that the change, which is 22, is like 48 or roughly 50 unicorns, and then next year it's 2 unicorns, and also it's a mix of all. It's like the global things, the fund, as we are discussing that last year was more focused on to early, stage startups up to Series A and all. Even like Singapore, India has also seen the same. There is a degrowth, but there is a percentage pie increase for the up to Series A startups, and that's even the new funds, like most of the funds are not focusing. Another thing what happened in last one and a half year is, or see more, that these new ideas, the tech, the AI, all of those themes has come up. So there are a lot of companies are coming to start onto that. So these are again on the early stages. So people are more, or the investors are more focusing to that side. Now coming to the other side, that what the companies who are touching that thing which is about to unicorn and to be unicorn, what they should focus on. So yeah, when it's a B2C, you definitely has to focus on your customer service and the brand in the market. That's definitely one thing which has to look for. I think this was there even 2 years back, 3 years back. This is the initial narrative every investor, or every company, or every founder look for. Then it comes now on to that how you are structurally organizing your fundamentals in terms of finance and operations, and even the non-finance fundamentals, how they are being driven. I think the same thing we were discussing in last session also. So this is important from that way, that it is important that why now you are picking a unicorn. Now the investors are coming, they are giving you the value, they are giving you the value not only just on growth. Yes, that is required, the same example of parenting and one kid to another kid. So you have to show the growth, but it is required to show the path of profitability, and that a strong story about it is gonna be happen, or it's profitable. So even if you see that in recent 1 year, 2 year, while we have seen low unicorns, number of unicorns, but we have seen that now there are startups who are converting positive. Their startups are saying, they are putting their narrative in market that this segment of us is going to be EBITDA positive. The startups are saying that by this time we are going to be profitable. So this is the thing which is coming up. One is on the profitability side, then on the growth side is going to be there. It's not that it is one or the two, you have to focus both.
The most interesting thing about yesterday, I met a startup doing 500 crore revenues.
Yeah.
And the best thing they were saying is to stay away from the narrative of unicorn. And they were focusing on generating cash. I think that's a good move too.
Yes,
Stay away from the narrative.
That's a good move for complete ecosystem, for the both side of the table, be the investor or the startup ecosystem, that we all started together focusing on that bottom line along with the sustainable growth. That's something long term and good for all of us.
Nritya, you have a lot of unicorns in your portfolio. How are they? You talk to a lot of them. How are those founders recovering? I mean, a lot of them had bad press.
Yeah.
So, I mean, some of them really had to go hide somewhere. I mean, people did those kind of things. I mean, the write-ups that you see every day, sensational, right? So how did these founders react? What's going on?
Honestly, they don't let it affect them at all. Like, I think from the outside in, we think that a lot of this noise is the reality of what's happening. I think, I'm sorry, I know I'm going to take a punt at the media, but that when there is no news of like new fundraisers, etc., you've got to write hit jobs on people. The reality of building a business anywhere, and particularly in India, it's an extremely chaotic and messy, like pulling your rocket together as it's like taking off kind of a thing, right? And you can always nitpick on certain things. Founders, honestly, this is just like water on a duck's back. It's rolling off them. They're doing what they do best, which is heads down building. All of these companies have showed up plenty of capital that will allow them to hit profitability and gain complete control over how and when they go out next to raise money, or how they think about the public markets. A lot of companies now are thinking about listing a little bit sooner and not waiting for your $5, $6, $10 billion valuations and then going to markets, right? So there's been a lot of that rationalization, and honestly, noise is just that, noise. It is important as investors and different stakeholders of the ecosystem to dig a little bit deeper and really understand like what's happening under the hood, and then you realize some really formidable companies that will define India's consumption story into the future are still being built, and built very rightly so. So that's my take.
Okay. This is to all of you. I mean, Mickey, you can take this. Do you guys still believe in the power law? I believe in the power law, that a VC firm of the many companies that it funds, one thing gives all the returns back. One company succeeds. Do you believe in the power law, or do you want to say that we've invested in 100 companies, we need at least 70 of them succeeding? Or would you still say that if we have 10 companies succeeding, that's enough because our LPs have got their money back? What are your thoughts on this?
The venture business itself is a power law business, but that being said, at least, I mean, I can only speak for our firm, and we're completely committed to building deterministic outcomes in a very non-deterministic field. And it's true, like there are incredible businesses to be built across the board. What we mean is that we will not give up. We continue to sort of like double down on our companies, and very institutionally, we've built support for our companies, because everything from regulatory shifts to consumption shifts to like all of those things are out to kill startups, which are very fragile things. And as VCs, we have sort of an onus to build structural air cover for some of these companies as they build. And that's what 314 is really like invested in over the last 6 to 7 years. And it's done very well for us. So when you ask across our portfolio, do we have one winner? No, we have like 4 or 5 very large winners. And our hardest questions are about what do we sell now that some of our fund terms are coming, and what do we hold to IPO. So there are stories like that to be built in India.
Madhu, do you agree with what she's saying, that it's not one, but we are looking at all the companies, at least 60-70% of them to go up to a certain value?
See, in B2B, there are very less unicorns. B2B, B2C and B2B, they are completely different when it comes to the valuations and unicorns. Sorry, what was it?
No, I'm saying, would you agree with the power law thing? One company gives the firm all its returns?
Definitely.
Or would you say that we need to make all our companies succeed?
Not all. I mean, all companies cannot succeed in one portfolio, or from one fund. If there are 50% of companies that are giving you a meaningful exit, then the exit should be multiplied by 8 or something. If there are 70%, let's say 70% startups are failing and only 30% are giving you success or a meaningful exit, then it should be multiplied by a higher number. So if there are only a couple of startups that are giving you meaningful exit, your LPs and you are
so be
happy.
it, the LPs are happy. Got it. Mickey, Japan, although I've studied so much history about Japan, I don't know, do you guys get excited about unicorns at all? You should tell us.
Personally speaking, I'm skeptical about quoting the number of unicorns as a measurement of a certain ecosystem. Kishida administration announced its 5-year startup plan a couple of years ago, saying a couple of things. One, they are going to put 10 times volume of risk money to the market in 5 years. They are going to see another 10,000 startups out there in the market in 5 years. And also, they'd like to see 100 unicorns in 5 years. And again, I thought it was a joke. I shouldn't say this, but I think a unicorn, it's just an outlier out of the portfolio, a big portfolio. And I have been making a startup investment for more than 15 years. And prior to joining this government organization, I used to run a small venture capital focused on ICT. And one of the investments we made in 2008, it was the smallest investment I made in my career, 200,000 K. And we made an investment into a company called Heroes, doing a software game developing company for shogi. Shogi is a Japanese version of chess. It was a spin-off from NEC. Nobody expected that the company might even take off. But in 2018, the company got an IPO again. They reached $1 billion. And our investment,
that's amazing. You can clap, ladies and gentlemen.
Investment, 200,000 K, turned out to be $50 million. 250 times multiple, which was good from an investment perspective. But today, unfortunately, the market cap of the company is only $150 million. And in the market, the company is treated like a loser. That makes us feel like a very empty, very vacant as a capitalist. Rather than jumping on $1 billion, explode, they should have taken years to reach, let's say, $500 million. And then it could be a great company and respected. So I'm not sure whether sticking to unicorn per se could be a healthy argument. That's my personal opinion.
That's a great view, by the way. So that's, ladies and gentlemen, please clap to the audience, to the guests, please. That's amazing. Amazing audience, amazing guests. Now I need you to ask some wonderful questions. We've got 22 minutes of question time, so we'll go one by one. We'll start in that corner. Yeah, identify yourself, please, and please tell us what you do, and quick question. 20 seconds for the question. So we'll take many more people to
Quick question,
answer.
right? So, ma'am, you've been in Stanford, and you had Zuckerberg and Chesky coming to the classroom, and Valley has been so different from Bangalore. So, what are those things which you think founders here should learn from in the Valley? And what do you think from Bangalore or from India as such, founders from Valley or founders from other countries can learn? And same to you, sir. Like, what do you think are those which you think Indian founders can learn, and what do you think Indian founders have and you think are thriving from, which other countries can learn from? Quick question. Thank you.
Riti, you want to go for it?
Yeah, thank you for that. I think just broadly, I think we should learn as an ecosystem just how much of company building and support is just in the air in the Valley, right? Like, so there are certain truths about like institutionalized knowledge. How do you build companies? How do you build organizations? What makes for great leaders? How do you find your first few customers, etc.? There are very, very deep and very tight networks across founders in the broader ecosystem there that genuinely help you lift off as a company. I think we're, as an ecosystem, still very far from that. I mean, 6-7 years ago when we began, VCs, that's why I have a very important role to play here, particularly here, because you're sometimes the only person that the founder can confide in on what's really happening within the business, both emotional, mental support as well.
That's so interesting. So you play the role of the psychologist. I mean, that's
try.
tough,
I mean,
man.
we try, but like I definitely don't think we're qualified to do that. But the thing is, it's a lack of I think we're getting there. It's been incredible, the growth of the ecosystem, but we're still about 10, 20 years in terms of like institutionalized ecosystem support and communities to help founders sort of grow, right? Like, and to not worry about or find places where they can be vulnerable and honest and have communities where they can learn from each other. I think we need to learn that from the West. From what the Valley can learn from here, honestly, I think India there's incredible institutional support to build, but it's still one of the harder markets to build companies for, because when you start building, say, a consumer brand in India and you really want to win, you're not a consumer brand anymore. You become a supply chain brand. You become, like, you're building all of the back end to help you deliver the kind of customer experience that you're promising to your customer. It sometimes doesn't exist. In some cases, it's not formalized. So you need to go back and build it. Like, we're in a company called Licious. At the time that they started, there was no cold chain in the country. I don't know if you know this, like for
cold
meat,
chain for
like I
meat,
mean just around vaccines, but like even just around fresh vegetables as well, that was a very broken cold chain to begin with. A formalized cold chain didn't exist. Or for instance, if you're procuring fish from, I don't know, at least 20 different coastal points, you don't know what the price everywhere is. You don't know, you don't have the ability to sort of play that arbitrage of where you source what from for that particular day. These are all systems that Licious had to build. So what you see is a consumer company that delivers the very freshest of meat, never frozen, in a box that looks like it should house an iPhone. But in order to deliver on that customer promise, I would almost think that, like, Licious is one of the deeper tech or more institutional supply chain companies in the country today, right? So that's what you have to learn. Like, that systemic thinking may not be needed in the West. The other big thing is that because the US is a market that's so large, you do get very you have your blinders on about any other markets or sometimes innovation happening elsewhere because you've got so much to build for right within there. Very honest conversations I've had with VCs in the region have been, we don't even invest outside of the Bay Area. What are you talking to me about investing in India? Because there's so much opportunity. Like, I just genuinely am an expert right there. That's my network. It's completely a fair argument. But that in this today's world of like being so globally interconnected, like you've got to keep your eye on where the best companies are being built in different spaces and leverage that and use that as fuel to build what could be the best for the world, right? So that I think comes very naturally to us. Like we find the very best different pieces of it and cobble it together and build for that customer.
I have a thought. When you take money from somebody, how do you expect them to nurture you when you are expected to return that money back to them? So, I mean, I don't know, maybe India is so young as an ecosystem, they expect nurturing, but when you take somebody's money, you got to run.
It's an expectation, honestly, globally, and it's a very rightful one. You become partners, right? Like, I do
That's
know
the right word. You got to be partners.
You're partners. You're literally on the cap table. You own a portion of the company. The company does well, you do well. If not, no. If your founder is healthy, is completely motivated and driven to deliver on outcomes, then you win. So I'm sorry to sound so transactional, but generally we make money only when our founders are really motivated and invested in it. So we have to do our roles to support them in all of the ways
Absolutely.
that we can.
Round of applause for her, ladies and gentlemen. She's so right that we need good partners today and founders need them. Your question, you want to say something?
Yeah, I just want to add one more point here. So during 2023, when all the VCs took pause, they started focusing on more, how they can nurture their existing portfolio startups. So they did a lot for their existing portfolio startups, how to strategize their GTM, how to connect with their customers, how to build their team, and all those aspects. So VCs are not just here to invest money. And recently there have been more focus on portfolio management teams. So more and more VCs are started having portfolio management team which focuses only on their
Great point, Madhu. Great point. Next question. We'll come to center somewhere here. Somebody had a question here. Okay, why not? Go for it.
Yeah. Hi. I just want to know, like.
Can you identify yourself and then?
Yeah. Hi. My name is Ankit. I am into a startup world where we are working for an EV manufacturing company. So, as a VC fund, what are the I would say, before getting a money from VC was quite easy. I would say, since it was a very early stage, but now I can see like startups are getting more difficulty getting a fund. So would you see these kind of cycle will be continuing in the future, where the startup can able to easy get the money for their innovation? And second thing is when we get to know, as you said, sometimes VC also manage their portfolio. How do a startup get to know whether you are passive or active for getting the fund?
Oh, okay, the question of saying yes or no, you mean whether they'll invest in you or not. Have the closure cycles gone longer? Instead of saying a yes directly or a no, after due diligence?
See, your question, one thing, like you said that earlier it is raising a money was easy and it's not. I don't fully agree with this. See, the fundamentals which earlier also the investors or VCs or even the corporate investor used to look for, they are looking today also. So it is not that has changed. Yes, the change is that if you have a strong fundamental, committed to the things, have a long-term journey and path, so investors are committed into this thing. On the point of nurturing, whether it's a passive or active involvement, see, it all goes hand on hand. I have seen the examples where, founder doesn't like also. There are the cases where for everything founder look for investor. So these are the extreme situations. This should not be the case. That if it should be like the right word she has mentioned is partnering. So treat it like a partner, take the advice. Finally, it's you who are running it, and don't be dependent on them, as well as don't at all say that no, I don't want any interference. So both things will not work, and the midway of it is that raise your money, deliver the commitments, be on it, and if there is any unforeseen circumstances or any cases or any times or any quarters where there is a dip, be transparent, be open up, and give that confidence that this will be picked back. This is what.
So making in Japanese context, what do the startup founders want there? More nurturing, or it's much more advanced in a way, right? What's the scene like over there? Is it nurture or partner, or just say that we know what we're doing?
I think it's more like a partner type of a situation, because rather than for as a nature of the Japanese, we are not really good at making 0 to 1. Rather, we are good at making 1 to 2 or 3 to 4 or 5 to 10, because including myself, we are trained by the big company where they are very good at making money and as a closed innovation. So I think the VCs in Japan, they need to put more money onto the seed early stages as a real founding partner. But there's not much see a brave VC partners yet. Rather, they are good at making a follow investment in the later stages. middle to later. So I think it's a reflection of certain nature of
Got it.
nations.
Got it. Questions, please. That gentleman right in that corner in white. So you can ask next. You can ask next. That gentleman raised his hand last time. Yeah, come closer. That's better. Thank you. Quick questions, because I want to get more questions out of you guys. Okay, quick, 20 seconds, please.
Yeah. Hi everyone. So I am a chief of staff with a hardware company called Sindler. We build vision platform for generalizing automation. My question is for the whole panel. Generally, there is a little bit of uncertainty around investing in unknown technologies which are not being built.
Would your technology be unknown?
Slightly, yes.
What's it called?
It's
Computer vision?
It's not computer vision, it's object sentience.
Object sensing, okay.
So there is always seen a bit of reluctance in terms of understanding, and because I understand the bandwidth is limited, the information is limited. So my question is, how can we make this access better for both the parties, where partners or the investors can understand what we're trying to build? So what is that we can do to make your access better, make you understand it easier? And what are your strategies to invest more into hardware, considering India is becoming a big hub for that?
Okay, my thought on this is some of the best founders tell the best stories. They have absolute clarity on what their technology can solve. And that makes their lives easier, right? And like Mickey just talked about astro scale technologies, right? I mean, beautiful. You sold it better than the startup founder, I think, on space debris. So one is the storytelling for sure, but I would like your thoughts as well. How would you determine if this technology is valid, or you called it an unknown technology, but how would you determine that, okay, this fits into a particular category or vertical?
I think as an ecosystem, I mean, there's a lot of specialization also that exists within funds. How you approach, this is one of, so I work very closely with my companies after our first check as well, on how they think about their growth journeys, their fundraisers, etc. And one of the biggest things that founders get frustrated by is essentially why this exact thing, right? Like, why aren't they getting it? This is so obviously such a big thing for me. It's non-linear, it fits their model, but why am I not able to get them to understand how large this market is and why this is a non-linear bet? I always put it back on my founders. I won't do it on you, but I'll just tell them this is a communication, like it's a communication gap, right? One is you're not thinking about your audience in the fragmented way that they actually exist, which is there are deep tech expert funds who will have spent years focused on slivers and verticals and will understand you and have a great conversation. There are generalist funds who are scanning multiple sectors. They're not experts in everything, but they know everything, right? How you approach, or there are Indian funds, there are global funds who understand the markets or the customer side of something that you're building very differently. How you approach each of these, right? You make one monolithic deck, you shove it off to every single investor, you send the same pitch that you ratify to every single person, and you expect it to work. It's not the case, right? The same way that you think about your customer who you're building a product for, and how all of them are many faceted and they can be bunched into different groups and they should be spoken to very differently, you have to think about your fundraise also similarly. There are certain segments that you need to have an education pack that you send them before they engage with you. There are people that you should connect them with, that they should speak to before they speak with you. So they have the context, bare minimum context to have that conversation with you from. There are others with whom they just know it. Like all you have to prove to them is, hey, this is my timeline to sort of commercialization. And once that happens, here are my 4 different POCs and here's where that's going. And that's the guys on the deep tech front because they've seen this already. So approach this like you would approach it your customer base, which is very different needs, very different understanding of the context, and then build your product, which is your pitch, appropriately to sort of navigate it with the least resistance. But I will not let our VC fraternity go so easily as well. It is true that it is harder for us to take some of these risks given the money and the kind of money that we manage. There are specific timelines in which we need to repay it. So around 10 to 12 years in the top funds. So sometimes deep tech doesn't fit that thing. You need to come in at different points of your commercialization and it might fit the timeline that they're operating on. So there are several different reasons for why VCs give you no's, and they're not sometimes as simple as them not just getting what you're doing, right? It's on their end as well, how far in.
So you define the go-to VC strategy. Select the VCs that you want to go to and tell a story basis what they've
Be
done
very
so far.
methodical,
Yes,
yeah, about their context, what they've invested in.
I
You
hope
need to
you're
do
recording
homework.
this, huh? I'm not joking. That's great masterclass. Great.
Yeah, absolutely.
So next question, please. Gentleman right here.
Hi, this is Amar here from KDM. So I'm cluster head for Hubli, Dharawar, Belgaum. And my question is, what is your focus or strategy for reaching out to the tier 2, tier 3 ecosystems? Because we still find it very difficult for our startups to get them VC funding, even though they hold great technology, great IPs. So
Absolutely. The B2C people are doing a great job, but probably you're asking from the B2B perspective, is it?
for tier 2, tier 3
Yeah, from the B2C or
Cities.
B2B angle?
across.
Across, okay. Who wants to take this? Go for it.
Yeah, so same thing we were discussing during lunchtime and also, the focus is shifting. It's like the way you are asking that how to approach incubation centers are the first topmost thing, the way we are looking to approach. We started to approach practically on this, and most of the institutes and cities where we have these incubation centers are there, we are approaching to them. And we see now the potential in tier 2 cities like Jaipur, Pune, Indore, all of those cities, and the startup, the way it is growing, just a number, because I just got this number real time available. So 1200 plus startups are registered in Jaipur as a tier 2 city. So this is growing, this ecosystem is growing, and for us, how we are approaching, our first point of context, definitely there are various ways, there are various things to approach, but first and foremost that we'll approach to the incubation centers, and from there we start connecting, we start getting links, and obviously the circles we have, the connects we have, then it passes from one to another if it suits my interest to me. Otherwise, still the idea is strong, I'll pass it to someone else. So that's it.
Okay. Next question. Please, sir. Go on.
Good afternoon. My name is Sunil. I'm from HCG. And firstly, I think, Nitish-san, you spoke about the first story was fantastic. I think the second story, which you spoke about heroes going up and then coming down, I think it's more of a question and introspection to the community here, especially from a venture community standpoint, is, we all, so being an entrepreneur is difficult as it is, right? And everybody celebrates successes. And I think even in this forum every day we talk about success and how can you be more successful, etc., etc. But when an entrepreneur fails, when one of your investments fail, do you think there needs to be some effort made on the healing side of the process? So which means, if you have a fund and you have fund earmarked for maybe early stage, late stage, growth stage, and so on and so forth. But an entrepreneur who's gone through a journey and gone through a failure, maybe one of your portfolio companies, do you think there is a need for you to put together something to heal that and maybe do another venture with that person?
I think when you lose money, it never heals, but you can learn from it and move on. I don't know, would you guys, then you'll be building a separate business of saying, okay, we help you heal after you fail. Would you want to do that at all? I don't know. Is that something that business should do? Do you think VC should do? I think that's, I don't know, although I agree with him. I think for that there's the media. You can talk to us and we will bring you back to life again in a positive way.
No, we have invested in founders who we've built companies with that didn't have outsized exits again. We've bet on their second companies, bet on their third companies. I think across the landscape, it depends on the kind of relationship. There's a way to also fail well. We have had some experiences where you end up antagonizing your entire board and destroying relationships on the way there. So I think on the entrepreneur front as well, we have everyone's best interests at heart. I'm not speaking sweepingly across the VC ecosystem, but most of my colleagues I know would love to double down. They saw something fantastic with you. They've gotten proof that you can actually do it. And I'm telling you, we're in the business of taking risks, and when we've got the founder risk mitigated and we know you're a great thing, it didn't succeed for whatever reason, market or problem statement picked, etc., we would love to give you another shot.
Okay.
So yeah.
I want to ask, nobody's asked about AI, so I'll come to you quickly because we have to cover AI. I think after listening to the futurists in the morning, everybody's got scared of ask him AI questions. What do you generally think about AI? Is that a hype cycle, or it's here? I think it's here to stay. I think we better get used to it. But what about AI do you like? I want to start with you, Madhu.
Sure. I mean, whenever there is new technology come, there is always a hype and under hype. Always goes together. In 2017, when blockchain came, it was same for blockchain as well. There were one bubble which in which it was overhyped. They were betting their
blockchain was hyped.
life.
I agree.
It was overhyped in certain bubble. So they were betting on their life savings. People left their job and started mining Bitcoin. Bitcoins, of course, they did really good. Some of them did really good when they entered at the right time, and some of them who entered late, they didn't do much. So same happens with AI as well. There is one bubble where it is overhyped. They are completely into it. There are VCs who are investing a lot into AI startups, and there is another bubble where they are like, okay, there is something AI which will come to us sometime, but don't know how it's gonna work and all those things.
Okay.
But yeah, it's this bubble is not gonna deflate or go away very soon. It's going to be there. I don't see it's going away anytime soon, at least not in next 4 to 5 years.
I got it.
It's just the
So
beginning.
Claude's just told me that we're running out of time, but quickly tell me yes or no to AI. Quickly, Mickey, yes or no to AI? A thumbs up to AI? Somewhere in the middle. You, Nritya.
Same. Huge.
Yes.
Yes to AI. How
Yes.
many of you say yes to AI? And great. There's very few people saying yes to AI. My God, I think people still love humans. That's great. We are human. And round of applause to these people.